Hey, it's Rob. Welcome to the Everyday Investor, the hottest investment show in the world. That's right. I said it. I don't care who knows it. Often the challenge is we take our precious time, we go to work, we get a paycheck in order to eat. Nothing wrong with having a job, nothing wrong with working. In fact, I feel like if you have a job, you're blessed. But imagine a life where money would make you money. You could work a little less and take your time to spend it with family, friends, engage in a purpose greater than yourself. That is what the Everyday Investor TV show is all about, teaching us how money makes money, how we can grow our money. Now remember, whenever you're offered any type of investment opportunity, whenever you're looking at any investment opportunity, you always want to ask 4 questions to start. Number 1, what's the return on investment? 2, when do I get that return? 3, what is the minimum investment amount needed? And 4, what is the risk, the worst case scenario? Really looking forward to this show. We're going to be learning from Jamil. He's going to be teaching us how we can make money with the buy and hold approach. Don't go anywhere. We'll be right back.
I realize as we move forward it's the convenience of having something that is separately metered, has everything separate, and it's the onus on the tenant.
Hey guys, it's Ken from LegalSecondSuites.com, and this week I want to share with you guys the importance of separate heating systems. Again, when we have tenants in our houses, other than noise, the second complaint is temperature differences between the units. And by having a separate heating system, you can really mitigate a lot of your complaints that you get from your tenants. There's lots of ways that we can get separate heating systems. There's installing a complete separate furnace system in the other unit. You can do ductless mini splits. You could do furnaces that have zoned ducting with electronic dampers. There's electric baseboard systems. There's lots of ways that we can separate our heating systems. It is something that's very important. We do get a lot of complaints about temperature. It's something that you should consider. It's money well spent to make your lives much easier when you're managing your rental property. If you have any questions about how to do it, feel free to reach out.
The mortgage world has changed. Has your advice? Are you looking for a modern approach to your mortgage planning process? Advice tailored to your unique, ever-changing circumstances? Whether you're upsizing, downsizing, purchasing, or refinancing, the Kyle Ford Mortgage team works with individuals and companies to custom tailor the right mortgage product for you. Working with a wide selection of lenders, we're here to serve our clients and help them achieve their real estate and retirement goals. Contact the Kyle Ford Mortgage team today, Canada's mortgage choice.
Thanks, guys. Omar Khan here, guys, with a weekly market update. Now, the markets have not done too well to start the year, and that is because markets do not like uncertainty. Many uncertain things going on right now. War in Ukraine, terrible. You've got inflation. You notice higher prices, the gas pump, at the grocery store, etc. Not good. That leads to higher interest rates. Higher interest rates would lead to a slowing of the economy, thus lowering inflation. Now, ultimately, the reason the markets don't like that is because that is expected to lower corporate earnings. And ultimately, stocks are valued, or companies are valued based upon the amount of money they make or don't make. So we're going to keep an eye on all this stuff. Generally speaking, the market's a leading indicator. It's leading 12 months in advance. It's pricing in today what it expects to happen in 12 months from now. So if these things are not as bad as perhaps as the market seems, maybe if interest rates don't rise as much, or inflation is not as bad, or if this war ends sooner rather than later, this could all be positive for the market. Let's see how it plays out. But over to you. We'll see you guys next week.
Hey guys, it's Rav. Welcome back to Everyday Investor. We're talking to Jamil. He's going to be teaching us all about the buy and hold strategy. Jamil, thanks so much, man, for being on the show with me. Appreciate it.
I appreciate you bringing me on. It's exciting to speak to all your viewers today.
Yeah, I mean, it's always you've been investing for a while and have some properties. It's always we learn, you and I both, and it's always great to be able to give back. Before we talk about this specific strategy, how did you get into real estate investing? What do you like about it? Where are you kind of going with it?
It all started with picking up Don Campbell's book at a ripe age of, I think, 22. And from that point onwards, I was hooked. Kind of selfishly asked for a membership and got my family involved in that early, saying, listen, this is the right way, investment's the way to go. And ever since then, I've been I would say obsessed with it, reading as much as I can about it at any time possible. And I started off there and reading about opportunities. As a young person in school, you want to look at opportunities, but also how far your money can go. You can't really compete with investors in the GTA at the time. So I looked at surrounding cities to where I could invest in. And my first investment at the age of 25, I would say 2008, was in Hamilton. So I started off with that as a student rental. And from there, I knew this was a great opportunity. And from that point, I created partnerships and JVs with other individuals who were, as they say, surround yourself with people who are, better or smarter than you. So I surrounded myself with some quite wealthy investors, and they decided to partner up with me. And we started getting more student rentals and then moving to buy and flips. And now, commercial and multi-residential properties.
And then when you say joint ventures, these guys were the money partners and you were kind of the working partner?
Yeah. So we would go, in the first one, it was a third and a third. And then the second one, I was a working partner because I was a waiter at the Hilton Hotel. So I was not really making a big salary at that time. But with that, I had that work ethic, right? I was willing to get a little dirty and get in the house and deal with unruly tenants or deal with situations that maybe my other partners were not willing to do. And it's paid off quite well, because I always find that, as what Don says, is find a partnership where you find someone who has a weakness and is your strength. And then that way you can complement each other and grow as a team.
And so tell me the pros, kind of quickly, the pros and cons, for you in terms of whether it was, you said you started with student rentals, then you moved to flips, and now you're on the buy and holds. Can you kind of touch on each one of those?
Sure. So when I looked at the options of student rentals first, I was really interested in cash flow. Since I didn't have a lot of equity built up at the time, I knew that cash flow could be my best friend. And I could use that to leverage more equity for the next project. And I knew, based on underserved cities like Hamilton by McMaster, there was a shortage of, you can do the math, the amount of offered beds per campus versus how many students are enrolled every year. There was a massive shortage for student rentals. So, and the prices were quite reasonable at that time. And I knew that on average, you're looking at like $400 a room at that time. And the opportunity was that you could take a single family home and convert a living room, dining room, et cetera, or even a basement that's unfinished and add rooms. So you're talking about, we'd come up with an equation. And I believe at this point, it's still, if you can get anywhere over 7 rooms in a home near, McMaster, any major campus, the 8th, 9th, 10th room is all cash flow. That's the rough end ballpark that we've determined over the multiple student rentals that we did. And then going from there, we used the equity from that. Then we said, okay, let's look at some of these buy and hold, the flips. So we started looking in the Burlington area, and there were some opportunities there, Aldershot specifically. And those were interesting because we were looking at like off-market deals. Those we partnered up with really good contractors to come in and like 3 months, 6 months, and just convert the whole place and get it back on the market. Now, obviously, Burlington now is incredibly valued versus what it was 6 years ago, or 8 years ago. So there's definitely the value. The appreciation is a bit slower back then, but there was still opportunity to be had. And then fast forward to multi-res. I think over time, as an early investor, you're putting in a lot of sweat equity. You're spending hours and hours and hours on a property, dealing with tenant issues, dealing with the face-to-face and all sorts of elements of managing it, and not only being an owner. You start realizing your value for time. And multi-res, I realize as we move forward, is it's the convenience of having something that is separately metered, separate, has everything separate, and it's the onus on the tenant. I started realizing, okay, that's less onus on me, less time that I'm dedicated to managing, light bulbs out, or I have to deal with, lawn maintenance or something like that. So it kind of it's come full circle now that, you kind of appreciate and the value there, and you're able to scale a lot quicker when you have multi-res.
So with multi-res, are you talking like maybe a 6-plex, a 10, a 20? What's your sweet spot?
Yeah, my sweet spot is...
Speaking of which, I mean, Don Campbell, who's, kind of the Canadian guru of real estate, you would think he would want, 100 doors, 80 doors. One time I asked him, what's the best investment for you, Don? And he actually told me at that time, a 20-plex. Nothing bigger than that, just a 20-plex, maybe 4 stories. You don't need elevators. I mean, it was designed. Now, not just one 20-plex, you could have 10 of them, as opposed to, a couple apartment buildings with 200 units. So for you, Jamil, what's your kind of sweet spot? What would you like to look at?
Yeah, I would say right now, because I manage the properties myself, I would say anything under 10 right now is a good sweet spot for me. It's manageable. I like to get to know my tenants, every single one. I introduce myself with letters. I try to go knock on each one of the doors, let them know who I am, because I believe that we're in a business of not just being landlords, we're in a business of relationships. And every relationship you have with those 10 tenants, or 4-plex, 5-plex, going up to 10, there are dynamics in every building. Every building has a dynamic. Neighbors know each other. Neighbors might have issues with the first one down the row. So to me, it's a personality and relationships. And I think for me at this point, I think 10. And then if, once we scale bigger, then obviously it's going to be, a lot larger. But at this point, I think manageable is 10.
And when does it turn into commercial? Is it 6 and more, 5 and more? What's the number?
That's a great question. I acquired a property, which we'll talk about later, and it was just a 4-unit townhouse complex, and it was all under residential, financed under residential. And then I went in for a refi, and the bank qualified as commercial. So yeah, it was a real head scratcher for me, because they usually don't do that, right? It's usually 5 or more.
Yeah, it's 5 or more, 6 or more. So what was their explanation?
I guess the way it was set up, they said the way the structure was, because they're side by side, and they didn't give me any other explanation other than that. They said that the way it was set up, they said the way the electrical was set up, the plumbing was set up, that they felt it was commercial. But the MLS listing,
it's a lot easier if it's designated commercial anyways, because it's not based on Jamil, it's based on rent roll and so on and so forth. And I would prefer to buy 5, 6 units or more anyways. But no, that's very interesting. And so are you looking for undervalued, undermanaged, where you have to go in and do a lot of work, or are you looking to if you can just buy turnkey, where it's already done, you just purchase it, the tenants are already there, and you're making money?
Yeah, no. So I look, there's a few components to that, right? Like I look at it from the first point of view is, I would say, if it's undermanaged and there's a value play, I would always jump on that, because that's what I look at. I look at value plays all day, because that's where, the current landlord might not have the time or the ability to look at the pain points. Where are these pain points? And that's where I can see the most opportunity. For me, that's my initial look at most properties, is where I see this undervalue. So if there's opportunities for adding opportunities for income, so parking, laundry, let's look at the tenant profile. So little things like that can add huge value at the end. And if once we decide to scale bigger, then we would definitely start looking at turnkey. But I find that the opportunities, or I would say the gold mines, are when it's undermanaged, or there's issues with the building that like it's just an undertaking that's beyond, or a structural issue that's beyond what I would feel is comfortable financially to incur. Then I would probably take a pass. But most times I look at it from a lens that says, okay, what are people most people not looking at here?
Okay, great. So we're going to take a look at one of your properties right after the break and go through the numbers. We're talking to our friend Jamil. He's teaching us the buy and hold strategy with multi-family or more than 5, 6, 7 units, under 10. Don't go anywhere. We'll be right back.
Are you looking to buy an investment property and you're not sure where to source the down payment from? You may be sitting on it. Many investors find the first source of their down payment for their first investment property from the equity in their current home. The number one objection I hear is, well, then my monthly payment is going to go up. A couple things. What if you restructured that debt to make sure that you weren't paying out of pocket for that additional cost? Or what if you were buying a quality cash flow property that produced enough rental income to pay for that additional borrowing costs? Now, this may not be for everybody, but this is an exceptional strategy that works really well for getting people into that first property, that first investment. If you're looking for a customized solution that would work for you, reach out to myself and the Kyle Ford Mortgage team.
You've always dreamed of having rental income, but buying a rental property? Well, that's a tall order. Capitalize on the space in your home instead. Renovate and rent out that space with ease with LegalSecondSuites.com and the team at Wise Construction Group. With LegalSecondSuites.com, our talented team of BCIN designers, engineers, carpenters, and tradespeople can transform that unused space into a beautiful, legal, and safe rental unit. We're empowering the everyday homeowner to become an extraordinary landlord. Get more out of your home. Visit LegalSecondSuites.com for more information.
If you're looking to raise more capital, do bigger deals, and scale your portfolio, the Multifamily Conference is for you. The Multifamily Conference is live and in person May 14th and 15th in Toronto. Put yourself in the room with multifamily investors from across North America to network, learn, and have fun. Tickets are on sale now at multifamilyconference.ca. Shark Tank's Kevin O'Leary will be sharing his capital raising secrets. Joe Fairless, who controls almost $2 billion of multifamily assets, will be breaking down his scaling framework. And our other top speakers cover every single aspect of the multifamily business, including underwriting, financing, management, deal flow, structuring, and much, much more. Get back out there. Face-to-face networking is back. Reserve your seat now at multifamilyconference.ca.
Hey, it's Rav. Welcome back to the Everyday Investor. We're talking to Jamil. We're talking about student rentals, the flip, and now the sweet spot for him, buying 6 to 10 units with one roof, one furnace. Jamil, thanks so much for being on the show here. So talk to me about, let's go through the numbers on one of your latest acquisitions here. So where was this? Where was this located?
This was in Cambridge, Ontario.
Yeah, Cambridge. All right. And what did we buy?
So we bought a four-unit row townhouse building.
So 4-unit row.
Yep.
That's interesting. And
Yep.
how much did we buy that for?
$761.
700. I'll just put $760,000. And what was your down payment for that?
152.
Put 150K, and then closing costs.
Let's say like 25.
20,000.
Yep.
And then was this a big reno, some lipstick, turnkey? What was this?
So this is a great question. So this was we had 1 unit vacant upon possession. So we did put a reno into that. We put around 30,000 renovation into that. The interesting thing about this building is it's all separately metered. So they had their own furnace, their own hot water heater, it had everything built to themselves. So the only real cost for the owner would be snow landscaping and, general repair on the outside of the building.
Okay, so renos was just the 30K.
30K, 30K we did 2 units, so 30K, and then we had another 30K for the second unit. So we could say 60 okay, for 2 units. Yeah. Sorry.
$60,000. Okay.
Yeah.
So that is 8, 13. So what's that to you? 230? I think so. Yeah. 80 and 150, 230K. Right?
Yep.
Okay, so that's what your investment amount is. How did you find this property? Was it on the MLS? Was it off market?
It was MLS. Yeah. It'd been on the market for, I know it sounds crazy now, like 50 days. So it was, back then, this was January 2020. So not too long ago.
Yeah.
Not too long ago.
Okay. So $230,000, 760. Okay. So we buy for 760, and then your investment amount was 230K. Okay, and so obviously this money is appreciating. There's a mortgage that's being paid down, and then there's some cash flow. So give me those three numbers. So what was your cash flow? What is this cash flow on a year on this property?
So right now, so we're not going to speak about any of the refinance. So it'd be around, we would make on average 28.
28 for the year? 2,800? 28,000?
28,000 for the year.
28,000 cash flow?
Yeah, for the year.
Yeah. So that's over 2,000 a month cash flow. Fantastic. So 28K for the year, and then your mortgage was paid down by how much?
Well, we paid around 10,000 for the first mortgage, and the second mortgage would have been another, I would say, 7,000. So
17,000?
Yeah, 17.
That's what these four tenants. So these are four different tenants, right? Or were any of them up, down? So these are just four single townhouses in one building. Yep. So four tenants are paying down your mortgage 17,000. And then how much did this increase in value, would you say? Just naturally, what percent would you give?
Percentage. I know we're right now, all day in that area, it'd be valued at around 1.2 million. So we could do that.
1.2.
Yeah.
But you bought it for 760. So give me a conservative number. The most conservative number you could give me. How much did it increase in value?
Okay, let's say let's say $1 million.
$1 million. That's what it's worth now.
Yeah, the most conservative number someone would pay right now. Someone would pay $1 million for that property.
$1 million. You bought it for 760. You put in about 60. So let's just say, just for fun, let's say you increase the value 150K. Okay.
Mm-hmm.
Okay. So what does this add up to? 28 and 17 is 45, and 150. Is that right? 195? I think so. 195. So this is incredible. You lifted it 150. The mortgage is being paid down 17. The cash flow 28. So really, in that first year, 200 grand, but you're only into the property for 230,000. Is that what you're telling me? And this was acquired January 2020.
2020, yeah.
Yeah, that's almost 100% return, but you pulled money out.
Correct.
You refinanced this, but even if you didn't refinance this and we just left this all in here, I mean, you're making a significant return. How much did you pull out of this property?
Well, we pulled out pretty much everything that we put in. So we got it appraised at 1.2.
So you pulled it all out. So you're in this property for nothing, and it's spitting you out cash flow. It's decreasing because four people are paying down your mortgage, and you're getting a natural appreciation on this.
Yeah.
So would you say this is an anomaly, or are you saying that this is still out there? Just depends. It might be a different area, but you can still do things like this.
I think it is a bit of an anomaly. We found a property that needed some attention from a management point of view. The previous landlord was negligent and didn't attend to simple needs that the tenants wanted. And we are very lucky that we had tenant turnover when we acquired it. So most people who are looking to invest in multi-res or long-term hold, they have to account for, let's say if you bought it as is and just a natural carrying, you might have to carry the cost, or your return on investment might be under 1%, with the hope that you'd have to forecast out 2, 3, 4 years out that you would have tenant turnover, where you can infuse some capital and get some better returns. So to give you an idea, three of the 4 units were all paying below market rents. So we notice in these smaller tertiary cities that people are long-term or serial renters. So they're staying there for 10 years at a time. So, and they're comfortable where they are, right? They like to stay in that range because the landlord hasn't raised the rent in 10 years or maybe 5 years. So it's quite, going back to your question, we were very lucky in the sense that we had a turnover and people wanted to leave the building. And we had the opportunity to take advantage of that and say, this building's great bones, and we have some future thoughts on what we can do with it, and which could give us some additional opportunity.
And so, you got lucky with this property, but I'm sure you're actively looking for these types of properties, right? You're going through the MLS. You recently just got your license as well, right? Just to be able
Correct.
to do your own deals and other investors. So you're surfing the MLS. You're looking for. This was on the market for 2 months, which, that's not common. Even back in 2020, 2019, 30 days maybe. So if you're seeing something 60 days, then obviously it's stale. There's a problem. Maybe it's overpriced, or people don't have vision for it the way that you may have it.
Yeah, it's absolutely true. Like right now, what we're finding is that, on our team, we were having a lot of people who are being priced out of certain markets. So the idea of going off market or finding those gems or anomalies it's about getting the data and getting the right information and knowing the place, knowing that the fact that certain cities have a growing demand for renters. I love Cambridge. I love, KWC area, just because, the fact that I didn't even have to advertise and people were just knocking on the door looking for places. And now I'm thinking maybe I should have done midterm rental or short-term rental because maybe there's more opportunity. But there was an incredible cities that are on the tertiary market that we definitely keep an eye on. But the market right now, that's more of a market update, but more so, in Cambridge for a duplex that needs work are going for 800,000, maybe 900,000 right now. And those are top down. So prices have definitely scaled quicker than I would have anticipated. But, as investors, we always take advantage of that when there's a possibility to.
Yeah, and there's room here too. You have a day job as well, or you're full-time investor?
This is full-time, yeah.
Full-time, okay. Well, in that case, then, the almost $2,500 a month cash flow is needed. But for others that might have this and also have another job, maybe you don't need as much cash flow, and so you might be able to pay a little bit more. You have a little bit more outlay, but the numbers are still working. So you're not doing 100% on your money. Maybe you're doing 40% annualized or 30. You know what I mean? It still all works.
Yeah, absolutely. And I don't know if I mentioned this, but I do have a certification in construction technology. So part of that benefit was that I did a lot of the work myself. So I was a little bit more hands-on. So, I brought certain trades in to do the work, but at the same time, as you said, I'm always thinking about where the next opportunity is, where the value play is. And I'm looking at, what the competition is. And as your viewers would know, I think it's about the information. That's the most valuable thing right now. Not so much money, because money's available. Money's cheap right now.
Well, yeah, thanks so much for sharing. And on that note, Jamil, your information's on the screen there. Do you mind if people were to reach out to you to pick your brain a little bit?
Absolutely. I'm here to help. That's what I'm here to do. Anyone has any questions, I'm a coach in that way. And any questions you have, you can hit me up on my Facebook or Instagram. I'm available at any time. I'm here.
Okay, man. Very, very generous of you. Thank you so much for being on the show.
Thank you very much.
Yes. And thank you guys for watching. Without you, we would not have a show. If you want to go through these numbers again or see any of the previous episodes on demand, go to our YouTube channel. Make sure you subscribe. Until then, we'll see you next week. Same place, same time. Honey, love you. I'll be home soon. Bye, everyone.